Hello again, class, and welcome to another video, hopefully a short one, that I wanted to make about the profit and loss statement. It's something that we're going to be getting into in week 5 or 6, and it is the next logical progression through the different categories of studies that we've been doing. We started, as I've said before, with the soft side of business. Which includes vision, mission, strategy, the external environment, and then we pivoted into the industry environment, which includes 5 forces analysis and value chain analysis. And of course, the overriding concept that we're going for here is always competitive advantage. And how do you know you have a competitive advantage? Well, it starts by analyzing your performance. And so we move into the third category of study in business, which is the internal environment of the firm. Now, one of the key aspects of the internal environment of the firm is your financial performance, because your financial performance really dictates whether you have a competitive advantage. And the most important report, the most important document that management looks at, usually on a monthly basis, but definitely on a quarterly basis, is the profit and loss statement. Now, I refer to the profit and loss statement as the report card. In other words, that document is going to give you a sense of whether your strategy is effective, whether it's being implemented properly, whether you may be missing some things that you should be looking at in the external environment, whether something may have changed in the industry analysis, the 5 forces analysis. Because remember, just like you can change your positioning in the industry analysis, the 5 forces model, in order to attain a competitive advantage, your competitors can do the same thing. So if you pivot to a differentiation strategy because everybody else is LCL, well, you can imagine that at least one of them or a couple of them are going to, if you're successful, one of them or a couple of them are going to say, hey, we want to do the same thing. We're going to pivot to differentiation because we don't want Smart Post Sound or this competitor to be able to take that space away from us. And so this is the constant, it's kind of like the hamster cage, the hamster wheel that we run in business. We choose a strategy, we implement a strategy, we bring all of the knowledge that we get from the external environment, the industry analyses, the value chain analysis. We look at our financial performance, and if the financial performance is below budget, now remember, every company establishes a budget target. They have already said, we expect to do X amount of revenue, and we expect to make X amount of money. And if they make that, that's good. If they fall below that target, that's bad. If they exceed the target, that's good. That's really good. Although if they exceed the target and they don't know why, that's bad. So I guess my point is that management needs to be proactive and to make their decisions and experience the results of their decisions based on a purposeful act or a purposeful strategy. It can't be an accident. They can't wake up one day and say, oh my God, look at all this money we made. It should be planned. If it's planned and executed and successful, then it becomes what we call replicable. It can be replicated. And in business, your investors, your bankers, your employees, all of your various stakeholders, they're very interested that you did well in a certain period, but the big question is it replicable? Can you replicate it? So the report that we look at on a monthly basis or a quarterly basis is the profit and loss statement. And every company has one. If they don't have one, then they're not really running like a business. They're basically looking at their bank account and saying, well, at the end of this period, whether it's a month or a quarter or a year, if I have extra money in my bank account, I probably made money. That's not really good enough unless you're a little garage business and you just want to make sure you can pay your personal bills. If you want to have an organization that can generate value over and above and beyond what you personally need, you have to look at the financial metrics. You have to determine, do I have a competitive advantage? And you have to really have some sense of what your competitors are doing, and they're not going to tell you. If they're not a public company, then you're not going to see their financials. And so in my case, when I'm trying to determine, do I do better than, let's say, Formosa Group, I have to do some simple math on the back of a napkin. I know, for instance, that Formosa Group has about $8 million of rent that they have to pay before they cut their first sound effect. I have about $1 million. Okay, that's a big difference. That's 8 times more fixed cost than I have. They are spread out over a number of facilities. They have to staff those facilities. I also have to staff my facilities, but my question is, am I staffing them more efficiently and at a lower cost? Currently, that is the case. And you do that with all your competitors. Remember, Formosa Group is not my only competitor. I've got King Sound out there. I've got Periscope. I've got a number of small players, and I've got a lot of big players. Warner Brothers, Universal, Sony, Paramount, Technicolor. In the case of the studios, it's generally accepted that they don't make money, but they're in the business for a variety of reasons, most of it geared towards taking as much money out of the budget of a feature or television show to fund the studio operation before they get into profit sharing. And so even if they're losing money, if they can just accomplish that and then add that back to what they got out of their strategy, that's probably, in most cases, a positive result for them. So that's where we start. So the profit and loss is the scene of the crime. The profit and loss, basically, if you analyze it, it's going to it's the fingerprints of all the bad players and all the bad decisions are going to be in that P&L. And so you start to analyze it in a very deliberate fashion. Okay, now all profit and loss statements are laid out exactly the same. As you can probably imagine, at the very top of the food chain is revenue. That's the very first number that you're going to ever see on a profit and loss statement. It may be one number, or it could be a few numbers that add up to that number, because the company, and I'm one of them, and you'll at some point see a SmartPost Sound profit and loss. They want to see how much revenue is coming in to each of the activities that they perform for the industry. Why do they do that? Well, they do that because they want to see which activities the market is rewarding and which activities the market is not rewarding. So we track our revenue based on activity, based on each stage. So we have a big stage, stage 5. We have a little stage, stage 3. Where is the revenue showing up? We do sitcoms on stage 3. We do high-end TV and feature films on stage 5. If I see stage 3 is bringing in more revenue than stage 5, then the market is telling me something. It's probably saying, we trust you more for sitcoms than we do for feature films or high-end television. Okay? I don't like that, because I want to be in the high-end television business. And so that becomes a sales challenge for me. I'm not going to close stage 5. I'm not going to start doing sitcoms on stage 5. I'm going to share that data with the sales group here, and I'm going to have them go out and start to look for more high-end television, because we want that number to be higher than the number that we get from our sitcom stage. Understand? Okay? So revenue is at the top of the pyramid. The very next number, and I'm going to show this to you in a graphic, but the very next number, I want to tell you first, the very next number is direct costs, or cost of sales. You do not get sales without having a cost attached to them. In the case of my business, the cost are the editors and the mixers and all of the labor that is associated with the specific projects that we bill and that make up our revenue. That is what's called direct labor or direct cost. Hang on for a second. Hello? Okay. 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 No problem. That was an accounting question. Anyway, so where was yes? So the second number is going to be your direct costs. Direct costs are the kind of costs that go away if for some reason you're not doing any work. So when I don't have any shows or we go through a hiatus period, my direct labor, my direct costs drop because the mixers are at home, they're on unemployment, the editors are at home, I don't have a cost associated. And so your direct costs, they rise and fall with the amount of revenue or the number of projects that you have. Okay? You subtract direct costs from revenue, and you get another number. You get what we call gross margin. Gross margin is everything that is left over after you did the various shows, after we edited and mixed Genius, and after we edited and mixed NCIS, and after we edited and mixed American Housewife, and all of those shows, after we did all of that, we subtract our direct labor and we wind up with a chunk of money. And there is a temptation to say that that chunk of money, which we're calling gross margin, is profit, but it isn't, because we have another category that we now have to take into consideration, which is overhead. Overhead costs in any company are all of the costs that are ongoing whether you have any work to do or not. In other words, it's not tied. So for instance, you go through a slow period, your revenue goes down, let's say 50%. Does your rent go down 50%? It does not. So that's a fixed cost. Do your executive salaries go down 50%? They do not. So they're direct costs. Does your electric bill go down 50%? No, not necessarily. I mean, you might use less electricity, but that's a cost that is going to continue whether you have any business or not. And so those are called overhead costs. And that is essentially, that's really the business. That's the core business. That's the building, that's the branding, that's everything that people see that is not directly related to the work that you do. You could say the same about General Motors, let's say. General Motors has a lot of union members who make a lot of automobiles. They work on assembly lines. Those workers are direct costs. When GM shuts down a plant because sales are off, all of those people go home. no costs. Okay, so that's direct labor. In the case of GM or any company like GM, the executives, the buildings, the infrastructure, the leases, the credit lines that they're paying on, that's all overhead. And so that continues. Okay, so that's the difference between direct costs and overhead costs. So you take all of your overhead costs and you subtract them from your gross margin. What you have left over is, this is still not your profit. This is now your gross profit. Why is it gross profit? Well, because you have some other costs associated with the running of any business. If you make $1 million, and if the corporate tax rate is 28%, you have to subtract $280,000 from the $1 million of profit. And so it's not $1 million, it's $780,000. Okay? You understand? Of course, I can't hear you, but I'm just asking. And then you have that number, but then you do another calculation. This is the very last calculation that you do. You add back taxes, interest, and depreciation. You take whatever your bottom line number is, and you add back depreciation, interest, and taxes. Because what you're interested in is how much cash flow you have. And depreciation is the big item here. Depreciation is a non-cash deduction against your profit for tax purposes. I think we all know this story about driving a brand new automobile off the lot, out of the dealership. It depreciates. Suddenly it's worth 25% less. You just drove it off the lot. Okay, so is the car really worth 25% less? It isn't, but it is. From a financial reporting standpoint, for the dealership, that car does not have 100% of its value. For people who are in a equipment-intensive business like I am, we have millions of dollars worth of gear. And every year, the IRS allows us to deduct, I believe it's 1/7 of the value of the gear against our financials. So if we made, I don't know, again, if we made $1 million, we might add back $300,000 to our cash, because that deduction was never paid out. It is a paper adjustment that is made it's basically a tax benefit that is given to corporations. Now, that being said, it's a tax benefit given to corporations, but they're going to use that money at some point to retool. They're just not going to use it now. And so in the meantime, it boosts their cash position, their cash profit. And so EBITDA is the number that we use to establish the value, the current value of any company. You know, how much EBITDA do they generate? And then if you're going to sell the business, a business broker may say, well, we're going to multiply that by 6 or 7, and that's going to be the price of the business. I know this is exotic, sounds exotic, but I'm just giving you a taste of all of the factors that come into play in assessing financial performance. So anyway, I decided to write all this down because I know if you see it, it's going to be a lot easier to remember. And so let me just put this here. Okay. So at the very top, profit and loss. The very first number that we have, revenue. Okay. The next number is direct costs. with a little minus sign there because we're subtracting. And that leaves us with our gross margin. Then we have another little subtraction, right here. And that's the overhead expense. And then that leaves us with our gross profit, not our net profit. Then we subtract our taxes. And then we wind up with our net profit. But then we add back our depreciation, taxes, and interest, and we wind up with our EBITDA. Okay? Now this is best expressed down here. R minus C equals P. If I didn't say it before, I'm going to say it now. If I said it before, I'm going to say it again. Most people think business is very complicated, but it's all boiled down into R minus C equals P. So give that some thought. I've sent you all a tutorial on the profit and loss statement. We'll talk about it more. Before we have our next Zoom meeting, I'd like you to go online. I'd like you to find a profit and loss statement from a company that you're interested in, and to go through it, and to just identify the different aspects of that profit and loss statement. What is the revenue? What are the direct costs? What is the gross profit? What is the gross profit percentage? That's an important number. Every company has a gross margin percentage that they're shooting for. At SmartPost, we shoot for about 35%. That means that 35 cents of every dollar that comes into the company is spent, winds up in gross margin. The 65% that's gone, that was spent on direct labor and direct costs related to doing the job that we're hired to do. So that's where I'm going to leave it. I think that these videos are getting shorter. Sorry for the phone call, but let me know if you have any questions. You can always email me if you have any. But and look, in today's world, if you have an interest, if you don't quite understand what I've talked about, Google it. If you Google profit and loss, you're going to have 10 million articles that you can choose from, and any one of them will probably give you the data that you need to further understand the concept of a P&L. So until next time, I will see you later. Bye-bye.